In today's episode, we'll break down two important stories. First, we'll talk about the Pentagon Anthropic divorce, and then we'll talk about whether it's a good thing that the world just keeps borrowing. Welcome back to the Daily Brief by Zerodha, where we cut through the noise to help you understand what's actually happening in the most important stories from business and markets. I'm your host Akshara, and today is Wednesday, 11th March. Coming to the first story. So 2 years ago, Anthropic's Claude became the first large language model or LLM to operate inside the Pentagon's classified networks. The government clearly wanted to embed it into its systems, and it was fast-tracked through layers of security clearance that normally take years to navigate and had quickly found itself working across the breadth of America's government. Yet last week, the Pentagon designated Anthropic a supply chain risk to national security, a provision that it had once used to hamstring China's Huawei. Just as quickly as it found itself in government, Anthropic was asked to leave. Frankly, we started this story completely confused. Why was Claude in the Pentagon at all? Why was the American military pressing a chatbot into service? Without answers to these questions, it was hard to understand why this was a big deal. As we found out, Claude sits at the end of a long journey of military innovation, and knowing that history makes this fallout even stranger. So well before AI was ever a thing, the US military had used intelligence systems for a long time. Now this journey began with radar during the Cold War when the US lived in constant fear of a nuclear attack. To track any incoming bombers and later missiles, the United States connected hundreds of radars to IBM computers spread across 23 locations. Collectively, this became the Semi-Automatic Ground Environment or SAGE defense system. Now, SAGE was a massive push to the world of computing. The computers assembled for it at 275 tons were the largest ever built. And for the first time, these were all connected together through telephone lines, a direct precursor to the internet. With time, SAGE became a rule-based expert system. Its computers would ingest large amounts of data and match patterns, and what they did was pre-programmed by humans. But within very narrow domains, they let them automatically detect threats and assess risks. They even took over larger tasks like guiding missiles. But if they ever faced new situations they weren't coded for, they couldn't adapt. Now, all these early automation successes involve tasks that require a lot of computation, which took humans a lot of time. But ultimately, they only made simple decisions. Actual judgment calls were left to humans. But slowly, the sheer number of judgments the military had to make were growing. After 9/11, the US started collecting massive amounts of data. For instance, between 2003 and 2009, the number of drone sorties had grown tenfold. The feed from a single Predator drone required 19 on-ground analysts to pass through what was happening. They didn't have enough people for the task, and thousands of hours of surveillance footage sat unwatched, while more than one-fourth of on-ground coordinators reported being burnt out by the constant work, and the data pipelines only kept increasing. So the military tried cracking this problem by making computers synthesize data. Enter Palantir. Palantir had seed funding from the CIA, and it used that to build its Gotham platform, which took the algorithms used to detect credit card fraud and applied them to military data very effectively. It could take raw data streams and turn it into a collection of objects, people, places, events, things. More importantly, it could connect very different data sets and map non-obvious relationships between them. This was a machine that could find needles in haystacks. For instance, plugging together two very different databases, the Pentagon realized that in Iraq, militants were tinkering with garage door clickers, turning them into remote detonators for bombs. Before this, you could only get such information from someone who had seen it firsthand. That said, drawing connections is different from analysis. Gotham could not explain or reason through the connections it found, and it could not generate hypotheses or guess at the intent of someone else. In other words, it had a last mile problem. It still needed a highly trained analyst who was comfortable with the platform, and they would have to navigate its interfaces and understand what it was saying. Even though the US could observe a lot, this bottleneck stopped it from reacting to everything it observed. To close this gap, in 2017, the US launched Project Maven. At first, Google was to provide the technology for the project, but it pulled out because its employees protested the effort and Palantir took over. Project Maven used computer vision to process its data, and through deep learning, the model began making sense of those data feeds. It learned to understand the layout of a battlefield, what enemy property was worth attacking, and what one ought to avoid, like hospitals. It could spot new constructions or key changes on the map. AI had officially come to warfare, and commanders quickly realized how useful AI could be, much like most of us did last year. By 2024, Maven was being used across the world from Ukraine to Yemen. But there was a new layer worth adding. Maven would benefit from a large language model. Now, sometimes the military needed to process hundreds of thousands of pages of text coming in live, like situation or intelligence reports. Analysts, too, needed the ability to ask questions in plain English instead of learning how to work with every single one of the platform's interfaces. And you needed a system that could stitch data streams into intelligence reports which humans could understand. That is how Claude found its way in. So in November 2024, Claude 3 and 3.5 were added to Palantir systems. Those systems still did the heavy lifting. They linked all the data and operational systems together, but Claude was now added to the mix. It was the first AI model on Pentagon networks. The moment it entered US defense, Claude's footprint grew rapidly. Usually, there are many layers of bureaucracy one must cross to enter highly classified defense networks, and Claude was fast tracked through them. Over just 8 months, in quick succession, it was approved for general government use and then was given the thumbs up to become a defense contractor. Clearly, the government wanted it there fast. For these new projects, Anthropic created Claude Gov, a special version of its model that worked safely on classified systems and was particularly good for military intelligence tasks. By late 2025, Claude was completely embedded into Maven. Now the platform could produce intelligence analysis from start to end with no humans involved. But there was an issue. Anthropic had a tight set of guardrails on what its models would or would not do. They would not be allowed to make weapons, for instance, or surveil others. But that was exactly the world it was entering. In June 2024, Anthropic announced that it would modify those guardrails and it would make exceptions for the government. For instance, it would let the government use its models for foreign intelligence operations. There were some red lines it stuck to, though. The design or use of weapons or cyber operations was still out of bounds. But slowly, its ambitions were growing. Midway through last year, it was one of the 4 AI labs that entered exploratory agreements with the US Department of Defense for a maximum of $200 million. Under this, it would talk to the department, try understanding their needs across areas like intelligence or warfighting, build agentic prototypes, and see what worked and could be scaled. Shortly thereafter, it decided to offer itself to all branches of the US government for a single dollar. As these entanglements increased, Anthropic had to offer more concessions. In contract negotiations last December, Anthropic dropped its reservations on cyber or missile defense. Theoretically, you could now tell Claude to fire missiles and it would comply. But there were 2 exceptions Anthropic wasn't willing to budge on: domestic surveillance and creating fully autonomous weapons. But the Pentagon wasn't willing to listen. As this year began, the US raided Venezuela and captured its head of state, Nicolas Maduro. News reports claimed that Claude had been used for this, and if they were true, this would be a major escalation of LLMs in war, and Anthropic had no idea. So during a check-in, Anthropic asked Palantir about the operation and whether its models were put to use. To the Pentagon, this seemed like a threat. If Anthropic didn't like the answer it got, could its models refuse a request? And that's when things went downhill fast. On January 9th, Pete Hegseth, the American Defense Secretary, released a memorandum on AI which laid a theoretical groundwork for America dominating military AI. Hidden in there was a jab at Anthropic. The memorandum claimed that there was no space for utopian idealism in the military. Instead, in the next 6 months, all its AI contracts would be renegotiated until the US military could use those models for any lawful use. Hegseth didn't wait that long anyway. On February 24th, Anthropic was given less than 4 days. It had to sign away its model for all lawful purposes by 5 p.m. that Friday, else the Pentagon would invoke a barrage of laws. But Anthropic refused. Here, things get murky. The Pentagon claims that Anthropic was claiming veto powers over the American government, and in their telling, if there's a missile heading towards the US, for instance, you don't want to find out that Claude's guardrails don't let you respond. But what lawful use was it being denied? From both Anthropic's public stance and its leaked internal documents, it seems like their biggest fear is that its models will be used to surveil Americans, and the US government has lots of data on its citizens. It's already found legal loopholes to do so, but so far, that data was a fragmented mess until LLMs came around with the ability to construct from that messy data a scarily accurate portrait of someone's personal life. Now, Anthropic seems fine with processing data from foreign countries, hence the words mass domestic surveillance. If we understand this right, our digital trail is already vulnerable. Now, the Department of Defense made two slightly contradictory legal threats. One, it would use the Defense Production Act, which lets the US government forcefully procure emergency wartime supplies. And in this argument, Anthropic was indispensable to national security. At the same time, it would designate Anthropic as a supply chain risk, a designation reserved for companies from adversary nations like Russia's Kaspersky or China's Huawei. Here, Anthropic was a threat to national security. With this designation, no vendor to the US Department of Defense could use Anthropic for any national security purposes. In fact, the government claimed even wider powers that no vendor to the US Department of Defense could work with Anthropic in any manner, whether for Pentagon contracts or otherwise. That would effectively blacklist Anthropic from America's entire tech ecosystem, since most major tech companies, including Anthropic investors like Amazon and Nvidia, would be blocked from working with them. So far, the government hasn't pressed the first claim, but last week it formally designated Anthropic a supply chain risk. Meanwhile, the White House took things even further, instructing the entire US government to break ties with Anthropic, whether they had anything to do with defense or not. Anthropic has just sued the government over this, and this is where things stand. Ever since the Second World War, America's military didn't know how to make sense of all the information it had. In 2024, those capabilities had finally arrived. America finally had a way of understanding what its sprawling surveillance networks told it. Perhaps that power eventually was too seductive, because the US government would harbor no restriction to it, not even the privacy of its own citizens. To our eyes, this reaction was meant to turn Anthropic into an example. The larger story of LLMs becoming a tool of war isn't going anywhere. Within days of the Anthropic fiasco, OpenAI and xAI had already cut deals with the government. The company that replaces Anthropic, presumably, is the one that asks the fewest questions. If you prefer reading the daily brief instead of watching the video, check out the link to the newsletter in the description. Coming to the second story. So the OECD, the club of 38 wealthy, developed nations, publishes a global debt report every year that tracks developments in the world's bond markets. How much are governments and companies borrowing, at what cost, and who exactly is lending to them? We went through the entire 157-page thing. It's incredibly dense and technical, not least because it drills down into the nitty-gritties of bonds, which is one of the hardest things to talk about. The jargon is thick, the mechanics are unintuitive, and a 157-page OECD report doesn't make it any easier. But we're going to try and break down the most important ideas here, but that means we obviously can't cover everything the report says. We genuinely recommend reading the report itself to get the full picture. Now let's go over some basics first. When a government spends more than it earns from taxes, which is something that happens all too often, it borrows the difference by issuing bonds. So a bond is really just an IOU. The government says, give me 100 rupees today, I'll pay you 4% interest every year, and I'll return your 100 rupees in 10 years. An institution like a bank, a pension fund, or a hedge fund hands over the money and the government spends it. Companies also borrow similarly, but corporate bonds are perceived as being riskier than government bonds because, unlike a government, companies go bankrupt all the time. The gap between what a corporate bond pays and what an equivalent government bond pays is called the credit spread, and it tells you exactly how risky the market thinks that company is. The global bond market, which includes every government and corporate bond currently outstanding, adds up to a whopping $109 trillion. It is, by a wide margin, the single most important financial market on the planet because government bond yields set the baseline cost of borrowing for everyone. When government bond yields rise, everything from mortgages to business loans to consumer credit gets more expensive. So that's the context in which the OECD report operates. The 38 OECD governments collectively borrowed $17 trillion in 2025. Companies in OECD regions globally borrowed another $13.7 trillion, and together that's over $30 trillion flowing through debt markets in a single year, projected to rise further in 2026. Interestingly, the vast majority of government borrowing isn't new spending. Rather, it was refinancing old loans that came due with new loans or bond issues. About $13.5 trillion, nearly 80%, was just this sort of refinancing. Think of it like a homeowner whose 5-year loan is expiring and they don't have the cash to pay it off, so they take a new loan to pay off the old one. The problem is that the new loan costs a lot more. Between 2015 and 2021, interest rates across the developed world were extraordinarily low, in some countries, actually negative. Much of the borrowing during this period wasn't because governments were taking advantage of cheap rates, it was because they had to, especially during COVID. But the effect was the same. A huge stock of debt got locked in at near zero costs. And then inflation surged in 2022, central banks raised rates, and suddenly new bonds had to offer 4 to 5%. Now, the old cheap bonds themselves didn't change. If you issued at 0.7%, you kept paying 0.7% until it matured. But every year, some of those bonds came due and needed to be replaced at much higher rates. One third of all OECD fixed rate debt matures between 2026 to 2028, and current market yields are about 2% higher than what those maturing bonds were paying. Across trillions of dollars worth of bonds in the market, that gap translates into hundreds of billions in additional yearly interest costs. Now, there's another nuance to this. Inflation used to help with this rolling over of debt. That sounds weird, but let us explain. So, the OECD measures the sustainability of a country's debt with the debt to GDP ratio, or the total debt divided by the size of the economy. GDP is measured in nominal terms, meaning that it doesn't account for the effect of rising prices. So, when inflation is high, GDP swells simply because everything costs more, and not necessarily because the economy is producing more. That makes the ratio look better even if the actual debt hasn't changed. Now, from 2021 to 2025, inflation was high enough that this effect more than offset the rising interest bill. But now, inflation has come back down while the interest bill keeps growing. In 2026, for the first time, the report projects that while interest payments will push debt up, the boost that inflation gave to GDP is fading. The net effect is an increase in the debt to GDP ratio, meaning that debt has become more unsustainable. So, how have governments responded? Turns out they're borrowing shorter. Treasury bills, which mature in under a year, now account for 48% of total OECD borrowing, and the share of issuance with maturities over 10 years hit its lowest since 2009. The logic makes intuitive sense. Why lock in expensive 30-year debt when you can borrow more cheaply for a few months? But on the flip side, you have to come back to the market much sooner. If the spot rates also turn out to be expensive, then refinancing in just a few months will be painful compared to locking in rates well in advance. During the 2008 financial crisis, governments also ramped up short term borrowing and then reverted to normal within 2 years. After COVID, the same spike happened, but this time the short term share didn't normalize. It started climbing again in 2023 and hasn't come back down. Now, on the corporate side, the puzzle is different. Credit spreads are near all time lows, which looks like the market saying corporate credit risk has never been lower. But the report argues that's misleading. Part of the tightness reflects genuine health. Corporate cash levels are solid, earnings forecasts are strong, and default rates are falling. But a big chunk of the compression may have nothing to do with whether companies are actually safer. So, a credit spread is the gap between what a company pays and what the government pays. It's a relative measure. So, if government borrowing costs go up, the baseline shifts and the gap shrinks, even if nothing about the companies has changed. And while still rare, strikingly, some companies even trade at negative spreads to their own governments. This phenomenon has also related to how corporate bonds are traded. Since 2008, electronic platforms, ETFs, and algorithmic trading have transformed a market that used to be slow, opaque, and phone based. Bid ask spreads fell from 77 basis points in 2013 to 33 in 2025. The report estimates that about a third of the credit spread compression since 2013 came purely from improved liquidity in the market. Investors used to demand extra yield because corporate bonds were hard to sell. But now, that's less true. Layered on top of this is the AI story. Nine major tech firms raised $122 billion from bond markets in 2025, with projected capex of $4.1 trillion between 2026 and 2030. Total capex by all non financial US companies was about $3 trillion last year. So, can bond markets absorb AI related borrowing alongside record government issuance? There's no definite answer to that question yet, but three of our older stories may help you think about it deeper. The report also dove into who is buying all this debt and how the mix of the investor base has changed. Between 2015 and 2021, central banks were the dominant buyers. The US Federal Reserve buying treasuries, the ECB buying euro area bonds, the Bank of Japan buying JGBs, and so on. This is what's also known as quantitative easing, where central banks create money to buy their own government's debt, pushing yields down across the economy. Now, central banks peaked at 22% of the combined bond market in 2022. But since then, they've stepped back to 15%. Essentially, the biggest, most patient, most price insensitive buyer is withdrawing. Demand from pension funds has also gone down, and that's because of the shift from defined benefit to defined contribution pension schemes, most dramatically in the Netherlands and the UK. Defined benefit funds have to buy long dated government bonds to match future payout obligations, but defined contribution funds don't. So, if central banks are buying less and pension funds are buying less, but governments are issuing more than ever, who is picking up the slack? Enter hedge funds, mutual funds, ETFs, and retail investors. So, central banks and defined benefit pensions bought because they had to. Now, the new buyers are in it because they want to be for profit, of course. Hedge funds now account for nearly a third of US Treasury secondary market trading, and on platforms like TradeWeb, they make up a majority of sovereign bond trading in the UK and Europe. More than half of surveyed government debt offices say hedge funds are now the marginal buyers of their bonds. On a calm day, all this works well. But this also means they leave when conditions change or they don't see enough upside. Hedge funds use a lot of borrowed money to make their trades, and if prices fall, their lenders can demand more cash or force them to sell, pushing prices down further, triggering more forced selling. It feeds on itself. In fact, this is just what happened in April 2025 when US tariff announcements caused a treasury sell off, amplified by hedge funds unwinding positions. For one, the absence of a crisis doesn't mean there's little or no risk. Bond auctions may be going smoothly and volatility may be moderated, but that resilience rests on credible monetary policy, fiscal discipline, and institutional trust. Foundations increasingly under pressure. The buyer base has shifted in ways that make markets more liquid on good days, but more brittle on bad ones. And the bad day, if and when it comes, could arrive into a market carrying more debt at higher cost with shorter maturities and held by people less inclined to stick around. Now, coming to the tidbits. Shares of Dixon Technologies rose about 13% after the government approved its joint venture with HKC Overseas to manufacture display modules in India. The JV will produce LCD and TFT LCD modules used in smartphones, laptops, and TVs. Analysts say the move could boost Dixon's margins as the company increases local component manufacturing. Coming to the next tidbit, India has refused the International Energy Agency's request to release oil from its strategic reserves despite rising global crude prices. Officials said the reserves are meant for supply disruptions, not price management. India currently holds about 5.33 million tons of reserves, which are around 80% full. Coming to the final tidbit, Indonesia has reached an initial agreement with India to acquire BrahMos supersonic cruise missiles, becoming the second country after the Philippines to buy the system. The deal is part of Indonesia's effort to modernize its defense capabilities, especially in maritime security. The final contract value has not yet been disclosed. That's all the news I have for you. Thank you so much for watching, and see you in the next one.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.